audio, image.
Okay, hello everybody. It looks like I'm almost here. What's going on? Sorry, for some reason my screen is not being captured. We have technical difficulties. It's gotta be a Monday. Alright, I might have to reset this. Hold on. Let's see. Let's see, we have screen 1. Okay, that works. There we go. All right. We have technology up and running. Hey, everybody, it's Nathan Graham. I've been a local real estate agent now for 14 years in the Durham region here in Ontario, and I decided to do this new thing on Market Mondays where I'm just going to go live and share with you some of the things that are happening right now. News from the last week, bond rates, predictions, and everything else. I'm hoping that we kind of keep this going every single Monday or every Monday that I'm not on holidays anyways, and maybe I'll have to do this from a beach one day. I don't know. But anyways, let's dive into it. Okay, so about 4 days ago, what are we, the 18th? And by the way, I do drink coffee, so don't mind me here. On about the 18th, we woke up to a news article from BNN Bloomberg. Home prices will return to pandemic peak by the end of 2024. So very quickly, home prices across Canada are expected to climb next year as a year with expected bank of rate cuts poised to reinvigorate the housing market, according to a new report. Royal LePage's 2024 Market Survey 2024 released Thursday predicted that home prices will make incremental gains in the first half of the year. Those gains will be followed by larger price increases in the second half of the year, spurred by expected interest rate cuts from the Bank of Canada after historic rate cuts. Blah, blah, blah. I will send you the rest of this article so you can read it. So let's just highlight some key points. Royal LePage is forecasting home prices in Canada to raise by 3.3% in the first quarter of 2024 on an annual basis, followed by 0.2% year-over-year increase in the second quarter. In the third quarter, which that would start, what, January, March, April, May, June, July-ish, Royal LePage anticipates home prices will rise 3.3% compared to the previous year, following 5.5% year-over-year bump in the fourth quarter, landing at a median price of $843, back to the heights reached during the COVID-19 pandemic. Based on this forecast, by the end of the year, home prices will essentially climb back to their pandemic peak, not pre-pandemic, their pandemic peak, reached in the first quarter of 2022. Okay, so this is kind of a Canada-wide conversation, by the way. Obviously, we're not just talking about Durham region in here, but there's some exciting things that happened. So let's rewind history back to 2017, where we saw something very similar happen in 2022. In 2017, we saw this January, February, March massive climbs, and I actually remember it was Easter weekend that we hit a wall. Then all of a sudden prices went down. So we went up something like 140% and dropped 160% in like 6 months. It was absolutely crazy what we saw. Again, not dissimilar to 2022, February. Now, it took until about 2019 to reach those places. So that was only about 2 years out. Again, we're looking at that same pattern coming. We're about 2 years out, and all of a sudden they're talking about reaching the pandemic heights of what was going on. One of the key things, too, when we look at year-over-year increases is in 2023 this year, for January, February, March, we actually had a fantastic market. Same with April, May, and June, actually. We had a fantastic market. So that's why up here, when it says something along the lines of you might see a 3% rise, that's a pretty significant rise from where we are right now, because we've dropped a lot more than 3% since those times. So How true could this be? What could this be looking at? And what does this mean? Okay, so first and foremost, one of the big things I am personally paying attention to are the bond rates. I have the screen up probably way more than I should in my life. If you remember, though, last week when we talked about bond rates, they're sitting at 3.5, 3.6%, and they are now down much lower. So as a result, what's it called here? If I go a 5-year fixed rate in Canada, mortgage rates, we're going to go to Rate Hub. We talked about this one last time. Again, this isn't exactly what I'm going to go to give you the exact precise information. This just is kind of showing you the trends when we're looking at it week over week over week. And if you remember last week, the lowest rate we were able to get was 5.19. Well, now that has dropped down to 4.89. Our banks, the big 6 banks, 5.34 on a 5-year fixed insured mortgage. This is dramatically cheaper than what we were looking at. I had a good conversation with a good friend of mine from Scotia who was talking about the 3-year rate and how that was sitting at around 6.8, 6.9-ish, and now they're getting it for 5.8, and now it looks like you'd even be able to potentially get it even lower on a 3-year rate. This is all directly connected. As bond rates begin to drop, we're now 3.2. Down here in the corner, you can see over the last 5 days, so that was like even before the last video, we've dropped 25%, just under. In the last month, we've dropped just under 50%. In the last 3 months, we've dropped 75%. In the last year, we've dropped 12%. But in the last 12 months, so this is the year to date, last 12 months, we're still up 31%. So it is good to see these rates begin to come down. That's what's affecting this drive in the market. So what does this mean actually, we'll talk about the real-time data in a second. So one data point when we look at bond rates, when we look at market rates, these things are looking very good. Again, the Feds came out in the U.S. saying they're going to potentially cut rates 3 times next year. Having said that, Canada did come out in response to that and say they do not plan on following the Fed suit in that regard. Basically, what I believe the Bank of Canada, this is opinion, but what I believe the Bank of Canada is basically saying is that we're not going to allow the U.S. to dictate what we do. We're going to allow the markets, the inflation, and everything else dictate what we do and what they believe is best for Canadians as a whole. Either way, some people are predicting Bank of Canada bank cuts in Q1, Q2, first half of next year, and then definitely by the end of it. And we are seeing sub 5% 5-year fixed interest rates, which is going to drive our market up. So that's number one. Number two, I want to go to my lovely notice pages. So what this is our Toronto MLS network of what we see on the back end as realtors is going to massively change very shortly. But I want to go to my lovely notice pages. And what this is going to do is this is going to give me a snapshot over the last 14 days of kind of what's happening. And I want to show you this. So I'm going to go to Oshawa, for example, and I'm going to save and update. In Oshawa, the last 14 days, we had 80 brand new listings. 35 price changes. Now here's where it gets fun. Sold conditionals 53. We're not going to ignore that, but sold firm 73. So that means we had 80 of them that were, I'm losing my mind here slowly. We had 80 brand new listings and 73 sold firm in the last 2 weeks. And 53 were terminated. We have more inventory, and 11 were suspended. We have more inventory coming off the market than added. This is fantastic in regards to supply and demand when it comes to selling your house. So, again, remember, if we have, this is basically showing that we have less than a month's worth of inventory that's being added and taken away, that we have this surplus of inventory that's been building up over the last little while, sure, but the last 2 weeks, and this is normal for December, very normal for December, but the last 2 weeks, we've seen very few people list their homes, and yet we still seen a lot of sales. As a side note, this is why it's not really just a line when a realtor tells you December is a good time to sell. There's less supply, but the demand doesn't really let up a whole lot. It does a bit, but it doesn't let up in the same way as supply does. Anyways, coming into January and February and March, typically what we see is this lack of inventory is going to carry itself over. A lot of realtors end up listing homes and their expiry dates are December 31st. They want to start the new year off fresh. A lot of people go over the holidays and decide that they don't want to move. They just saw their house decorated beautifully for Christmas. They made family memories. These are all things that kind of go into why people may not want to move. So we are going to see usually restricted inventory from January, February, and March. And this restricted inventory will play a role into what our market will look like. So again, a combination of less inventory, lower rates is usually a good sign for a big, robust spring market. Now, how does this relate directly to you? Because this is the very important part. This means if you are, like I said in my last video, if you are sitting on the fence about buying a home, and you're waiting for a sign or whatever you're waiting for, get out and do it. Call your realtor, have this conversation today. Largely because, again, we looked at last November's numbers in the last video, and home prices went up 0.3%, which means we've hit the bottom of a market. We've kind of hit a consolidation period, and it looks like we're about to bust through what that market looks like. Now, where that goes, I don't know. That happened in 2017. It started happening in 2022. In 2017, you could still get a condo for 350, 400,000. Now you can't get them under 5, even the low market that goes to 6. Is the next benchmark 9, 8, a million? I don't have a clue on that regard. What I do know is that we still don't have enough housing for the demand in the long term, and rates are beginning to come down, and these are all going to create a bigger market. So talk to your mortgage brokers, talk to family, talk to your real estate agent, talk to whoever. If you're sitting on the fence, that might hurt you in the long run, and I want this to be your warning. Please just pay enough attention to have the conversations. You don't have to act, just have the conversations. Same thing if you're sitting on the fence about an investment property. As homes become less affordable, investments are becoming more valuable. So if you're sitting there thinking, when is a good time to invest in the real estate market? I want to wait for it to bottom out. This is where we're at. We are at that bottom out phase. So please reach out to your realtor, start talking investment opportunities. I will back up and tell you, we do seem to have a flood of rentals on the market at the moment. Rental prices do seem to be coming down, but that doesn't mean it's a bad time to buy an investment property. Again, we just have an influx of inventory. A lot of people can't afford their homes right now. So they're putting them up for rent, or a lot of people bought and they couldn't sell for the prices that they wanted to sell for, so now they're renting to recoup what some of those costs are. That supply will filter itself out. It will. It's not going to happen. As soon as rates start coming down, rates are going to be driving all this, bond rates are going to be driving all this. As soon as rates start coming down, then that will start filtering itself out. So it is that opportunity. Now, on the reverse side, if you are thinking about selling, again, this is crystal ball prediction. Do not take it for anything more than what it is. Just, again, let this just foster a conversation. If you are thinking about selling, we have one of a few things that I think will end up happening into the new year. Number one, it can stay completely boring. I could be wrong about all this. We can stay completely flat, and it doesn't really happen. Well, whether you sell now or you wait a couple weeks, that's not really going to matter a whole lot. And I want to back up, by the way, even in a boring market, we're still going to have seasonal trends, and our seasonal trends are typically January, February, March, April, very hot markets. So either way, it stays boring. Let's say I'm right, though, and let's say that we start to see small incremental increases. Well, then, fantastic. You're now going to be able to net a little bit more for your property. And if you're doing like something moving out to the East Coast, or you're looking at making a change, retiring, whatever case may be, it could be a great time to capitalize on the booming market. Because I also see this potential happening. If real estate starts to boom too hot and starts to go too crazy, and we start to get above trend lines that the government doesn't like, they can do things sooner to put a stop to that booming market, because they already feel housing is out of hand as it is, which could mean a couple possibilities. Again, we could have a boring market. It could mean we have this big booming robust market that just carries on. It could mean we have a massive booming robust market that the government puts a halt into. And it could also mean that we just have slow incremental rising. Now, what could this look like? I think it's January 1st. I'm going to double check my notes for the next video on this and get some verifying. But a luxury tax has just went into properties over $2 million in Toronto. That is going to slow down their market to have to pay a luxury tax when buying a house. Governments right now, for some reason, we're crazy tax that it is, are not afraid to tax us more. So there are things they're going to do to slow us down. Anyways, this is just a quick-ish, 15 minutes, a bit longer than my last one, Monday market update I want to talk to you about. Please, if you want to grab a coffee and kind of dive deeper into this, if you want to talk about getting pre-approved, if you don't want to miss some of these lows that are going on in the housing market, reach out today. I'd love to sit down and just have a conversation with you. Let's talk. Have a great one.